Good morning. This presentation is for this particular online lecture class is for become same-sex management accounting. Now we starting where we left from with a bit of recap elements of the balance sheet. Now current assets. Current assets which includes inventory. Now this composes almost entirely 90%. It 70% to 90% of the company's whole expenditure on manufacturing. Now, this inventory, it exists in three forms, that is raw materials, work in progress, and finished stock. Now, generally, a raw material which we bring in, as previously said, it requires certain time, say maybe a week, maybe a month, to convert the raw materials into finished stock. However, when say the financial year closes on a certain date, say as on 31st March, all the raw materials on that date will not be converted into finished stock. So we have a work in progress. Now, this work in progress will maybe at three different stages. It may be at say work in progress, say 30% complete, 60% complete, 90% complete, or so on and so that and so forth. And now we also have the finished stock. The finished stock here in this case is mm, the finished stock in this case particularly is mm, the complete stock that is in the godown of the company, or that is in the company's hand, that has not been sold to dealers or has not been sold by the company. Now, the prepaid expenses. These prepaid expenses, for example, it may be the expenses that the company has paid ahead of time. These include, say, if the company is insurance for the company's premises, it expires on December 31. The company renews it on January. The company renews it, and the insurance period starts from the period of January to the period of December. However, the financial is from April to March. Then only the company can take 3 months of the total insurance charges. If the total insurance charges is 1200, but the insurance for the current financial year is only for 3 months, that is 3 by 12 into 1200 or 300, and 900 is for the period of March to December, which will be treated as the prepaid expenses. Now we also have the elements of the balance sheet in property, plant, and equipment. These include land, building, machines, and equipment. Now, what do you understand by the term machine, this property such as land and building? These are fixed properties. However, the plant and equipment, these are capital assets. The capital assets, what is the difference between normal assets like these fixed assets, like normal assets and capital assets? Now, fixed assets, capital assets, when these assets can be used for the production of certain items that are sold by the company in the normal course of business. They include, uh, say, the machines which, say, a plastic casting machine which prepares, say, plastic boxes and all from plastic pellets. Now, that particular machine is an capital asset because it helps the company in producing the items that it sells in the mm, market. Now, current liabilities, like previously we had said, that there are accounts payable and accounts receivable. Accounts receivable is just sundry debtors, that is the people who buy amounts from you in credit. Now there'll be people, or there'll be companies from which you buy amounts on credit, mm, and these are known as also syndicators in the balance sheet, and these are the bills which the company owes, or the amount which the company owes to vendors or the suppliers. Now, the current liabilities. Now, banknotes are the secured loans that the company has borrowed from a bank. It may be a term loan, it might be a financial institution, or it might be a single person's also. Now, other liabilities are short-term liabilities such as unsecured loans, such as bank overdrafts and others, which are usually also accruals. That means the charge which has accrued but which was due but not paid by the company, and so on. Now, balance sheet analysis. Now, balance sheet analysis can be defined as an analysis of the assets, liabilities, that is the change in the assets, liabilities, the change in the ratios and all that, and equity of a company. Now, what do we mean by the equity of a company? The equity of a company is the owner's introduction of the capital in the company, and generally includes equity shareholders and preference shareholders. Now, generally sits on the liability side of the balance sheet. Now, there are two forms of the balance sheet: the horizontal and the vertical form. Now, the single or we have the first and only the asset side of the balance sheet, and then we have the liability side of the balance sheet, or we have both the asset sides and the liability side of the balance sheet shown together. Now, this analysis is conducted generally, however, at intervals of time, like annually or quarterly. Now, intervals of time like annually or quarterly means if it is set at, say, annual intervals, we get all the cash flows, we get all the assets and liabilities. It's annually or semi-annually, that is after 6 months, the company produces these figures. But if we conduct it at, say, in intervals like quarterly intervals, we will not have all the elements or all the data together, and we will only have data such as the um, um, sales figures, the change in profit, and say the purchase of raw materials and all that. We will not have all the figures of inventory of current assets and current liabilities. Now, the balance sheet analysis, it comprises of basically two things. One is the ratio analysis, and the other is the trend analysis. Now, the ratio analysis or trend analysis, say it is done with comparison to the previous year. The ratio analysis, say, it comprises of, say, current ratio, asset test ratio, gross profit or net profit to sales ratio, among other things. And the ratio analysis, it gives us a debate is the amount is different for different industries. For example, for certain industries, the current ratio up to one is healthy. For some industries, the current ratio more than one is healthy, uh, and so on and so forth, because it depends on the type of the industry that the company is engaged in business. However, the trend ratio, and trend ratio, it actually only deals with a specific item. The ratio deals with, say, the current ratio deals with current assets divided by current liabilities, and so and however, the trend ratio, it only checks what is the change in the current ratio with respect to the previous year's what's the change in the current assets with respect to the previous year current assets, what is the change in the sales with respect to current year sales with respect to previous year sales, what is the change in say raw materials expenses with respect to current year expenses, and so on and so forth. Now, in the case of balance sheet analysis, for example, in case of ratio analysis, we have current analysis, gross profit or net profit to sales ratio. These are two of the examples. Now we have the current ratio, which is the current as by current liabilities ratio, the gross or the net profit to sales ratio. Is how much of the gross profit or the net profit could be retained in comparison to the sales that are incurred by the company. In case of trend analysis, by the company. Thank you. It's all for the